Great. I see we have a quite full house here. So then let me get started with introducing our guest today. So I'm starting with Kurt Björklund. I hope I pronounced that well. Kurt is the managing partner at Permira, and I saw he's been with that firm for an impressive 24 years already. So a lot of continuity in the management. Of course, he is on various committees on the companies. Kurt has a Master of Science in Economics from the Hanken School of Economics in, I guess, your home country in Finland, and an MBA from INSEAD, which I might mention is also the most popular business school among Moonfare employees. So there's a lot of fellow alumni there from the school. And before joining Permira, Kurt had a quick stint at BCG, the Boston Consulting Group, so started your career in consulting, which he actually has in common with Steffen Pauwels, who I'm introducing next. Steffen started the same year, I noticed, at Björklund, as Kurt Björklund, but in a different country in Germany in 1993. Served a little bit longer, probably to complete the PhD, which took longer than the MBA, and then started his first company, first out of a number of companies. Then he sold before joining KKR, where he served for 12 years, last as the managing director for Germany. And then after Steffen left, he of course founded Moonfare, among other companies, and then is currently our CEO, and as I say, fearless leader in all our endeavors. Maybe a quick note on Permira, the company that Kurt is heading. It's one of the premier, I would say, buyout firms, and among other firms with over 44 billion euro. I noticed you're reporting in euro in committed capital. And the approach is really, as Kurt says, thematic growth. So Permira is well known for its investment in tech, in healthcare, in consumer and services, and we probably hear a bit more about it. And those investors on the Moonfare platform who've been with us for a while had also in 2019 the opportunity to invest in Permira 7, which has also invested already, which raised over 10 billion euro and has made quite a few interesting investments. With that said, let's get to the first question. I've been talking far more than I would like to. And Kurt, first of all, thank you so much for joining us on our webinar here. And just to start with what is on a lot of people's mind is coming out of COVID. Hopefully we are coming out of COVID soon. Where do you see the opportunities? What do we have to expect in a post-COVID economy? And where are the opportunities, where the risk? What's your view on what's going on right now?
So first of all, thank you for inviting me. It's a great pleasure to be here. Looking forward to this conversation. I think when we look at the world over the next couple of years, it's a few different, quite meaningful dynamics going on. The first one is that you'll have probably for the next 12 months, you have a bit of revenge spending mindset amongst consumers. So people sit with the combination of not having been able to travel, go to restaurants, and spend things that they typically would, and fiscal stimulus checks in the US and various forms of that in other geographies. So I think we'll see a very meaningful kind of through the summer, escalating the fall, winter economic rebound. But then that'll be coupled with a surge in inflation. I think we're already seeing that. It's driven by supply chains, which are jammed up in everything from semiconductors to car components to the cost of delivery and so forth. It's driven by this demand, and then the central banks, who will probably not be politically bold enough to rein in the monetary stimulus early enough to deal with it. And then I think a third phase of it will be a hangover phase, because you have such a massive buildup of, let's call it broadly, liabilities in the economy. You have government debt that has spiked. You have many companies whose balance sheets, especially those on the kind of losing side of the structural shifts, balance sheets will need to be fixed. You have employment that will need to be recreated in the hospitality sector. I mean, in London only, where I sit at the moment, 21% of people work in hospitality, and you can just imagine how much new creation you'll need to re-employ people that have sadly lost their jobs or whose jobs have completely changed in nature. But all of this will happen in combination with a continued massive and meaningful shift in profit pools structurally in the economy. So that's what we are seeing, and as investors, that's the dynamic that we are backing, where you see how software is replacing human processes, amplifying human processes in companies. You see how consumers are going online for their financial services needs, their shopping, their insurance needs, and so forth, the healthcare needs, and that creates tremendous opportunities.
Mm-hmm. Great. I mean, you mentioned the hangover of phase that at some stage might come. Are you also concerned about inflation and what kind of effect, if we get it, would it have on deals and returns in private equity, you think?
Yeah, it's interesting, right? Because most of us, in fact, if I look at them, gauging the age of the three of us on this call, none of us have actually experienced in our professional careers meaningful inflation, at least in our domestic economies, and we are having to relearn what that really means. And to me, it goes back to a couple of very simple things. Cash is very toxic, especially when it's combined with a low interest rate environment. And therefore, what you want to own is, it's quite simple when you boil it down to it. You want to own real assets that are growing, that more and more people in the world want to have, and that have pricing power. And one form of real assets is companies. So if you own number one market leaders with meaningful pricing power, that will, in the medium to long run, take you through a stint of inflation. In the short to medium term, though, we do need to be prepared for what we've pretty much always seen when inflation ticks over a certain limit, is that the equity markets take a big beating. So when you risk calibrate where market valuations are at the moment, I think there's a lot more downside in the public markets, especially than what there is upside. I think that's an easy thing to say, but I really do believe that. And therefore, anything you do, you need to take a long-term perspective on what's the sort of utility of wherever you put your capital for us as a humanity in the long run.
Yeah, interesting. And do you venture any guess on the timeline until things are running hot or we might get into trouble on public markets?
So timeline when things are running hot was yesterday. So inflation data is lagging. I studied macroeconomics like a million years ago when I did my degree in university, and macro data is a very, very lagging thing. So if you look at when inflation actually comes through to the numbers, you've started seeing it now in some of the monthly updates in the US, in the UK, in some European economies. But when I look at real life, if you look at what it costs to ship a container from China to Europe, or you look at what's happening with semiconductor pricing, or again, automotive components, to use three kind of convenient and easy examples, it's already there. It's already there, and it's in the system, and it's only a matter of time before that then translates into reduced purchasing power and increased salary demands. And when the inflation data shows it, it's often too late to start thinking about it in terms of positioning as an investor. So I'd rather assume that it's happening yesterday and be proven wrong in this set of circumstances than wait for it to show up in the lagging macro data and then react.
Yeah, maybe here to lean on, Kurt, what you have been saying. We are seeing, and this is really unprecedented, the combination here between the fiscal stimulus, which is often, by the way, forgotten, and the low to zero interest environment. Because just in terms of fiscal expansion, we are seeing that global government spending has increased by 20% of global GDP. So we are talking just for the US alone about a program of $5.9 trillion that's floating into the markets over and above to the central bank stimulus, which is out there since years. But on the other hand side, we are seeing also deflationary developments. Yeah, you talked about the global supply chain. Yeah, and then sending production really to the lowest cost areas globally, but also the digitalization. But anyway, you can't play the cycle. And as you rightly said, so what is the recipe? It's, I think you said, a shift in profit pools, really taking advantage of this shift. And then we all know that, and this is why I'm very confident for private markets, a little bit different from my view on public markets, where I think the exaggeration is happening. But in private markets, we are seeing that the best time to invest, actually, in terms of empirical evidence, not personal opinion, is in downturn cycles. And this, combined with your shift in profit pools going into tech and growth areas, seems, at least for me, to be a compelling recipe.
I completely agree with that. Exactly. I think just one nuance that I would look at a bit differently. I think the deflationary trend that we've seen in the world through supply chains moving initially to China and then to Vietnam and so forth. I think we've at least hit a pause button on that, and maybe a bit of a reversal button for that. I don't think that's a kind of permanent state of affairs, but due to geopolitical factors and COVID kind of making nation states and redomiciling supply chains again, that acts against that dynamic that we've grown up with over the last 30 years.
Yeah, great. Thank you. There's one question from the audience which fits well, and that relates to SPACs. So the special purpose acquisition companies. Do you see them as an opportunity and a market in the context of exits for Permira, or is it still more like a second class to the IPO or other exits?
So what matters to me is only the quality of the companies that are underlying. And that's really all that matters. And then you have these, I mean, if I'm provocative, I'd say it's a bit of a flash in the pan, because the market circumstances were incredibly conducive to raising SPACs, and the SEC in the US and regulators more broadly are catching up with the fact that there's no logic to the disclosure arbitrage that exists between a traditional IPO process and a SPAC, and therefore that arbitrage should and will shrink and over time go away. Plus, I think there have been some fantastic SPAC-driven IPOs. There have been others with companies that, at least in my judgment, that's a subjective view, but at least in my judgment, shouldn't be public companies yet, because they are too far off from proving that they should be bought by retirement savers into their portfolios with appropriate risk reward. So I think SPACs will always be there as a legal mechanism or a financial market mechanism for companies to enter the public markets. But I think there's a blowtorch on that segment now, which is running out of gas soon.
Anyway, talk about provocative. Kurt, in your investing, is there any insight or conviction that you have that most other investors might actually disagree with?
I don't know if other investors would disagree. I think that's probably a little bit presumptuous to say, but if I kind of look at my big learnings of the last 24 and a bit years by now, I can really crystallize it into a few things, and two that stand out are, I think one is that our industry traditionally, if you look at where private equity sort of emerged from, has been a little bit too much focused on loss aversion and not enough focused on upside optionality in how we look at companies and investment opportunities specifically. So the industry has had a super, there will be some of my industry peers that perhaps started 10 or 20 years before me that will say, like, the one thing never to do is to lose capital. And the message that I give to our organization is not go and lose capital, but is focus your calories on upside optionality and how we really can get these 5, 8, 10, sometimes 15 times the money outcomes if things really work out well. And the way you get there is by having a more kind of scenario-based approach in how you look at probabilities of what might happen with the companies. So, and this was a big pivot. We were very base case centric as an investment firm, and this was a huge, quite heavy transformation that we went through 10, 13 years ago. I mean, our loss rate is still, and I don't want to be self-promotional, but still, it's only about half of what the industry average is. So I don't mean that we are happy to take losses, but where our firm outcomes stand out, it's that, I mean, if I just take the last 25 exits we've done, I think 10 of them are at north of 4 times the money, 8 of them are at between 5 and 18 times the money. And the way you get there is by putting the bulk of your calories on how do we create a portfolio where in every company there's 1 or 2 or 3 ways of really winning big. That could be industry consolidation, or taking a European company into the US successfully, or a kind of product packaging, pricing transformation. And if you expose yourself to those outcomes, then in a whole portfolio, we have now about 55 companies in our private equity portfolio, a sufficient number of them will come through in size. So that's one. And then the second one, and this is really simple, it's sort of basic private equity psychology. I think our industry traditionally has tended to clip the winners too early and ride the losers for too long, because you have a base case that say we want to get to 2.8 times or whatever the money, and then someone shows up 3 years later and offers you 3.5 times the capital, and everyone says, job done, we move on. Where what you really should say, okay, but what if we have a clear winner here with great growth momentum, market leadership in a theme that's showing long-term structural growth. Are you at this price? Are you a buyer today if this showed up on your desk, or are you a seller? So one of the big changes we've done is that we have a very disciplined re-underwrite process where a few years in, we look at this as a new deal and we say, okay, so if this showed up at the current kind of valuation, do we want to just double down and hold it for longer? And that's then what allows you to move your portfolio from the kind of 2.5, 3 times gross the money on average to meaningfully above that. And conversely, it's often an ego-driven reason if you hold on to the losers for long, because you sort of told your partners that I'm buying something and I'm putting in index 100 of equity and it's going to be 300 by the time I'm done, and then something happens. Either you get it wrong, or something external happens, there's a market cycle or something else, or you lose a big customer, and your ego tells you that, damn it, I said this to my partners and I want to prove it out. But more likely than not, those investment calories, that time is better spent just accepting that we got something wrong, let's learn and move on and deploy those on something where we will do better.
Yeah. Can you share any example? And I saw there's a question also about the Permira 7 portfolio. I'm not sure, you won't have the time to go through all the details, but if you have any example for the upside, maximization that you're seeing in the portfolio?
Yeah, for sure. I mean, for Fund 7, it's too early because that's by definition a fund. We only started deploying that. It's about halfway deployed. We started deploying that in October 19, so a year and a half and a bit ago. But if you look at Funds 5, 14 vintage fund, and Fund 6, which is a late 16 vintage fund, I mean, in that, and even the later tail of our Fund 4, I mean, I can mention a number of companies like TeamViewer, which, by the way, 2 of these are public, so I'll be very careful in how I phrase it, but TeamViewer and Doc Martens, both of those we could have sold. We had offers on the table at 2 times, 2.7 times, 3.5 times, 4 times the money, and every time we said no, we believe we have a real winner here, and we wanted to see through that growth, take them into the public markets, and by consequence of taking them into the public markets rather than selling to a financial or otherwise buyer, continue to benefit from and ride the upside on those. I think a really good example is Genesis, which we carved out of Alcatel-Lucent in 2012, which was at the time, it was then already the global market leader in software for contact centers. And it was a $1.5 billion buyout then. And that company, I mean, it's a private company, so it's hard to say what the valuation is, but in our books, we hold it at close to 8 times the investment. And that's been a complete pivot from a one-off license model to a subscription license model, moving the delivery from on-premise software to cloud delivery, massive M&A roll-up of product and technology companies in that space, and it's performing incredibly strongly. So that's another example where we just see this sort of ever escalating velocity in value creation when we get it right with the right team. And of course, the risk in a known segment with a known company with a known management team, it's much less than the risk in a new segment with a new company with a new management team. So kind of backing the stuff in the tent already can oftentimes be a good amplifier for outcomes.
Yeah. It's actually a great question from the audience here that corresponds with that. It says, how can you hold winners for longer given the fund life? And are you comfortable selling an asset from one fund to the next?
Yeah, really great topical question. So first of all, if you think about the private equity fund structure, people sort of talk themselves into a corner of saying the average hold period should be about 5 years. But the fund life is actually 10 years. And then the fund, depending a bit on which firm and which fund, can be extended by 2 or 3 times, 2 or 3 years at the tail end. And then after that, you need to have a plan to liquidity if you haven't sold everything yet, but you don't have a hard stop where you must sell the companies. So already in the existing fund structures, our 4th fund, which is a 2006 vintage fund, we still have Genesis is in that fund. We still own that company. And after 13 years of the fund life, and we just told our investors, like, we have some great winners here. We want to stay invested in those. We did last year, we did a continuation fund where we offered our investors, if you will, complete optionality of either staying in, invested with exactly preserved economics to what they had before, or selling out to a secondary group that came in, put in some new capital to replace the capital that stepped out. So the kind of private equity repertoire with the products that we have already gives meaningful ability to hold companies for a decade, if you want. And we don't feel that we need to create a long-term hold fund or anything like that with lower returns to solve it. We believe that we can hold them already for a decade within the fund structures that we have. When it comes to cross-fund transactions, I mean, I think that there's always a conflict in those. I could see circumstances where we would do that. So if there's a new meaningful owner coming in and we keep a tail and we pivot that into the next fund, but we haven't done that for a decade because we haven't felt the need to do that. I think it's really important. You want to keep the organization entirely aligned with the return outcomes for investors, and anything that you do that moves you away from that entire alignment then you're sort of starting to compromise on I think a fundamental tenet of how the model works.
Great, thank you. One question that came up in the chat, and I think I mentioned that to before, that's kind of a classic from our investor community, is always, are you worried about the multiples? You know, that it's increasingly competitive with a lot of dry powder out there, and how do you manage your deal flow and avoid overpaying?
Yeah, so that to me is one of the absolute topical questions of the day. The answer is yes, I'm very worried about it. And so I started again in '96. So I've kind of seen 3 run-ups to a meaningful cycle doing private equity. So the late '90s dot-com boom and then subsequent bust, and then the lead up to the financial crisis and the hangover from that. And then what really is now, let's not forget, we've had a 12 years bull market in our backs. And the risk is always that people get intellectually lazy when anything that you didn't do, 2 or 3 years ago, with hindsight, you should have done, simply because you've had that market and macro tailwind, and that's dangerous. And then furthermore, I think what we're seeing now is a similar move to self-referential valuation environment in some high growth segments. So people say, I'm going to pay whatever 18 times forward ARR for this company because so and so paid 17 times for the competitor, and that's not healthy. So, and the crossover mindset of saying that the public markets today value this segment at X times Y, And if I can get the discount of 20% to that, then I play the arbitrage between the private markets and the public markets. But we have to remember that the private markets don't have that liquidity. So the way you look at valuation needs to be very data-based, based on the fundamental unit economics of the companies, the growth companies we're backing, both with our control fund and our minority fund. And they need to sustain a wide range of market scenarios of the sort of nature that we've talked about today. Because my son, who's 18, is dabbling in crypto trading. And one of the things I always remind him of is that any investment strategy that you have, if you take a 1% chance every month of losing all your capital, that means that once every 8 years you lose all your capital, and it won't matter that you've done well in the meantime.
Good. Let me ask you, based on a couple of stats from the past, a follow-on question here. We've seen in private markets 3.4x more value creation happening than in public markets in the past years, since 2000. We are seeing also a 50% decline in listed companies, and now I'm talking US data. And then, you know, Gartner and others, they are forecasting that over the next 10 years, 20 trillion US dollar will be created in private markets in terms of value creation. Being positive on what you've just said for the future, do you see this trend to continue in that way, with that speed and with that strength, or do you see it calming down a bit because of so much money now floating into private markets, even away from public markets?
Yeah, so I think your question is really about segregating the structural shift versus the perhaps cyclical shift that we are observing in the markets. I think there is no doubt that the private equity governance model produces better results than the public markets governance model, because you get so much agency costs and kind of layers in between the actual capital and the actual management of the company, whereas in the private equity model, you sort of collapse that into one sandwich. So the governance model has a clear competitive advantage in a Darwinian governance model competition, and therefore private equity will continue taking share. But that competitive advantage in the governance model doesn't make a meaningful difference in all companies in the world. It perhaps makes a meaningful difference in 10 or 20 or maybe 30% of companies in the world. So that's kind of how I think about the overall growth opportunity in private equity. And today, I think as an industry, we are maybe 2 or 3% penetrated of overall global equity capitalization. So there's a long, long way to go for the industry. If you just look at the very sort of 60,000 feet top-down view. And then the other trend within that, as you mentioned, Steffen, is this instinct where if you were a healthcare tech entrepreneur 20 years ago, Nirvana was getting to $100 million or $200 million in revenues and floating the company and having a market cap of $500 million. Today, what we see is entrepreneurs really appreciating the simplicity and, importantly, the increasing liquidity that there is in the private markets, and choosing to remain private until the company is worth not $500 million, but maybe $5 or even $10 billion. And this, of course, because the company value grows like this over time, it amplifies the addressable market for us as growth investors very meaningfully. And you get to that point where the sort of venture capital and angel investor cohort that the company started with, it sort of ages out, and there's often an opportunity for us for a very meaningful minority investment or a control investment while the company is still private. Then there's a cyclical element, which is, I mean, you mentioned at the moment there's more SPACs than there's companies that can go public. The public equity markets are very receptive at the moment. The window is kind of wide open. That it's not always going to be like that. The window comes and goes a bit. So right now you probably had a bit of a walk back where companies again go public a little bit earlier because they can. But the underlying structural trend, I think, will continue being very supportive of the private markets being able to continue absorbing an increasing pool of capital. But having said that, it is intensely competitive, and I am highly worried about some of the valuations in some segments of the market. So we steer away from those and focus on places where we think that we see better risk reward.
Yeah. So obviously a big part of the growth that we've seen in the past in allocated to private capital came from institutional investors, and we're just starting to see that changing with more and more also being interested in individual investors, high net worth capital. From the institutional side, the LPs, what are they concerned about these days? What are their priorities? And to include some question here from the audience also, what about ESG and where does kind of, I think, an increased demand for ESG meet the reality in the investment practice, versus there's concerns around greenwashing, and how do you incorporate that into your strategies?
Yeah, so I think 4 kind of top of the mind things for our investor partners. One is what we just talked about. So a lot of capital valuations high. How do you navigate that? The second one is the sort of thematicization. I'm not sure if that's a word of the industry. So the industry is moving from a product-centric view. There's a buyout fund, and there's a venture capital fund, and there's a growth fund, and a long-term fund, and all that. To a sort of, how do I deploy capital over the cycle into these interesting companies with growing profit pools, and who do I back to do that? And how do I, as an investor, for those of our investors that have co-investment appetite, how do I kind of create my own direct investment program that lives as the yin to the GP's yang? The third one is what you just asked specifically around ESG, and to me the most meaningful sea change that we'll see over the next 10 years won't surprise anyone, but it's climate change. So you're seeing now, and finally now, this is something I care personally a lot about, we are seeing the combination of consumer demand, and I don't mean preference, I mean real demand, for environmentally sustainable products and services and solutions. You are seeing the regulator finally, probably 20 years after the fact, becoming bold enough to push through some meaningful changes. And you're seeing technology enabling the creation of really interesting new product services and offerings. And these 3 things, this creates this sort of self-reinforcing flywheel where I think, and I was very worried. I mean, if you remember Al Gore and his movie, The Inconvenient Truth, that happened just before we got into the financial crisis, and then the world kind of pivoted elsewhere. And I was equally worried with COVID. The climate discussion in the world was really starting to gather pace, and then COVID happens and all bets are off, and people say, look, the skies are blue, so we don't need to worry about climate change. But I don't think that humanity has forgotten about the importance of this. This, of course, will create, over the next 20 years, I think the opportunity creation, the profit pool creation in climate change driven businesses will be something comparable to what we've seen in technology enabled and driven businesses over the last 20 years. The latter won't stop, but climate change driven opportunities will be massive. And then the fourth one is a lot of LPs are focused on diversity in our team and inclusion. And it's one of these things where we come from a background, very sort of multicultural background, with offices across different European cities. And when I started in the firm, we already had an office in Southeast Asia and in Japan and in Canada and so forth. The business has shifted a lot. But if you let an organization like ours go on autopilot, what happens is that people hire people that look and feel and think and talk like themselves. So unless you combat that actively and force diversity into the investment team, your talent pool will actually deteriorate over time. And the LPs are focused on it. It's one of these things which has been triggered by, there's an underlying need, but it's been triggered by a sequence of different events over the last couple of years. And it's a good triggering event for us as a firm and for the industry to respond to when our investors show up and say, okay, so what is your gender balance in the firm, and how do you ensure that your teams can have a create a family while they build their careers over 2 or 3 decades in Permira, and so forth.
Okay, we have only a few minutes left. We always normally end this with a few 2 questions on more like personal reflection, and maybe if you could just in a short sentence say what advice would you give your younger self if you're Kurt 24 years ago starting working for Permira?
Yeah, interesting. I mean, Oscar Wilde, right? If I quote, he said, "Be yourself because everyone else is already taken," and I think that's incredibly powerful, right? Because at the end of the day, anyone that starts in the industry or in a new firm, the only job that those people have is to either make the firm do something that they otherwise wouldn't do, or not do something that they otherwise would do, right? Otherwise. The new talent doesn't add anything, and I think in our industry it gets to just daring to have a bit of a contrarian mindset, because if you do what everyone else in the industry does, then you'll just end up with the same returns, and that kind of cohort in the industry will over time revert to the mean. So just while you do your day job as a new entrant to the industry, and that will mean having to do the spreadsheets and collecting data and analyzing that and coming to a point of view on an investment, just dare to also define who you are yourself as an investor that is different from everyone else in the market, because that's the nucleus, that's the seed around which your career and your position in the industry will grow.
Awesome. Last question, if you were to summarize your time at Permira in 1 word, what is that word?
I'll use a word which, again, I'm not 100% sure it actually shows up in the dictionary, but it's kaleidoscopic. So you remember those toys we had when we were kids? You shake them and you look in them, and every morning it looks different. And that's what working in the industry and working in Permira has felt like to me, because you wake up every morning and you shake the Permira kaleidoscope, and every day there's a different set of opportunities and challenges. The key is that you keep it sort of pointed in the right direction. You're really clear on which direction you point it and why, but then you deal with whatever pattern emerges that day, and are just the best person you can be that day.
Awesome. Steffen, I know I heard you ask the question a few times, but I've never heard you answer it, or at least I've forgotten the answer. What's your word?
Look, for Moonfare, it would be innovation. And to your question, what would be my advice to my younger self? There was this famous book, I think the name of the author was Malcolm Gladwell. And he was writing about what does it take to become an expert in a given field. And he took some data from athletics in the US, and then he came up with this famous 10,000 hours rule. So it means you have to do something for 10,000 hours before you're really an expert in it. And this is something that might be true, for the past. When I was young, if you become a professional player in basketball or something, but it's absolute nonsense in my view for the future. Because today, data, access to knowledge, all this leverage is out there, and you can achieve things much, much faster than this. So my advice would be courageous, go out, and don't wait for the 10,000 hours to become an expert.
There's an amazing book, Steffen, on that topic called Range, by a guy called David Epstein, I think, which is a really worthwhile read. He makes exactly that point.
Great. Okay. Awesome. Thank you. So we are exactly at the end of time. I think we leave it here. Thank you so much, Kurt, Steffen, and also everybody in the audience for joining us today and for this lively conversation. The next deal talk will be in September. So we are taking a summer break and then come back with other awesome speakers, hopefully as good as today. If you haven't had the chance, please do sign up for the Moonfare platform so we can stay in touch, and we can inform you on upcoming events, great content that we're producing in other opportunities. And signing up only takes a few minutes or less than that, actually. And it's a requirement to be able to share all the great content that we have on the platform that is not available for regulatory reasons on the wider website. Of course, it's free and without any obligation. And then both we can keep in touch. And you can also explore all the opportunities that we have for investment, current one and in the past. You know, you can look back at what the over 35 funds that we have already had on the platform. And you can also look out if there's any Permira coming up later in the year, hopefully. So with that said, thank you so much, everybody. Have a great rest of the day and the week, and hope to see you soon when we're getting together on our next webinar.
Thank you.
Thank you very much.